Good morning, everyone, and welcome. This is Joseph Scarice, founder and host of the Creative Birth Strategies House and podcast, live here every Saturday morning, 8 a.m., and every Sunday morning, 9:30 a.m., providing education, networking, and strategy. We'll get ourselves set up here in a few minutes, and we'll get started with our discussion this morning on recapitalizing and lowering risk with a rental portfolio. So, few things. We'd love to thank a few people. Obviously, to get started here is obviously our sponsors. We'd like to start off with thanking Perkatech, Mr. Yardell Perkins, in regards to our social media, our podcast, our partnership. He provides social media audits and evaluation and opportunities to work with him in regards to website work, graphic art, just a plethora of social media techniques and strategies that I use and partner with him for the last, I would say, almost 10 years now. We're getting close to our uh, our almighty 50th podcast being loaded this week. So go to our website, creativebirthstrategies.com, where you can get to see all of our podcasts live and replayed. And then I'd like to thank Lenmark Capital, our asset-based lender, who provides direct private lending, and I'm the senior loan analyst for the platform, and we provide long-term and short-term debt on single family through four family, 5 through 25 units, new construction, fixed to rent, fixed to flip. I'd like to thank MB Capital, your unsecured business line of credit referral program for real estate investors, providing unsecured business lines for real estate professionals under the LLC. And of course, I want to thank Linda Pelagas from Realty 411. She's a national real estate publication and provides also national events throughout the country with real estate professionals and real estate experts and masterminding with real estate professionals trying to get their business up and running. So another announcement I'd like to make before we get really started into things is I moved my real estate licenses, and I'll be finishing up the one last license to move, and I will be under TCS Property Management, which is now becoming a national property management company, pretty much east of the Mississippi. They're going to be in some states in west of the Mississippi, primarily in that single family through 25 unit space for the landlord. There'll be referral program opportunities, joint venture opportunities to work with us. Just finishing up the transference of a lot of the licenses. Pretty excited about the opportunity. It's a very diverse real estate company. They own various different sectors in real estate. They own several Keller Williamses. They own Rittenhouse Realty Advisors, Gold Ollier Investments. Very diverse, very smart real estate investors and professionals. So I look forward to putting out some more information on that sometime this week. But again, TCS Property Management, based out of Philadelphia, down in Old City, and I think it's a really smart move for a lot of my landlords and a lot of my investors that are looking for off-market deals as well, because I'll have a hand grasp on opportunities throughout the country for my real estate investors that are ready to make a move. So another recap this weekend, I was at Mr. Landlord with Jeffrey Taylor for the weekend, just got back last night. Very exciting, very engaged real estate investors. Not a lot of inexperienced investors, not a lot of newbies, I'll say. No, people that don't own any investment properties. The average investor there owned anywhere from 1 to 300 doors. And the discussions were, I feel like, a 102 level. They were really trying to sharpen their tool shed in regards to understanding how to be better landlords, how to grow, how to scale. And I look forward to seeing some of the follow-up with a lot of the professionals I met there in Columbus, Ohio. And I'll probably meet up with a lot of them again at the Ohio RIA in November in Cincinnati. So again, let's recap a little bit on some news this past week. Rates closed out on Friday at around 7.15 on the traditional lending side. On the commercial lending side, rates dropped about an eighth. Our base rate now in lending on DSCR goes down. It starts at 7%. Construction rehab money has stayed extremely steady in the asset-based lending space from 1 unit to 25 unit. Base rate starting still at 10%. Not much different than bank rate. Bank rate's probably on the construction side, maybe 9.5. But the difference is they're looking at a lower leverage where a lot of the asset-based lenders out there are considering a higher leverage, and the expedition of the loan is taking big difference in time. Like a construction loan with a asset-based lender takes 3 weeks. A bank could take 2 to 3 months. So timelines are a little different as well. Another couple things on market trends right now. Let me get some information in front of me here. It looks like the equity increases to homes are peaking. We're starting to see some leveling off or decreasing. So some news that came out this past several days in regards to that. That's coming out. There's a state of mortgage credit availability that needs to be taken into account. There's definitely squeezing in the market for credit. And that's where like the unsecured business lines of credit come up and are so needed right now for our investors. I mean, so many investors that have a 700 plus score in LLC, a couple properties, and they don't have enough money to do the next deal. So again, credit availability, you need to keep an eye on that. With tighter lending rules, there could be an indication of credit tightening or loosening depending on where you're at. So another interesting article that I saw this past week, see if anything else caught my eye. Obviously, commercial mortgage delinquencies are up. They're not going to be going down anytime soon. There's definitely going to be a resettling of commercial real estate and how that will impact the institutional investor as well as the landlord, the individual landlord. So, and how will that impact your cash flow? How will that impact the type of tenant that's going to be attracted to your property? So these are the things that you need to think about. You're up against the big bad institution that are renovating some of these bigger commercial buildings. So our discussion today, recapitalization and lowering risk with a rental portfolio loan. Some key takeaways I'd like some of you to see is, optimizing the property's capital structure and attracting potential JV partnerships or cash flow or bank interests or asset-based lending interests. Knowing the mechanics of recapitalizing, the key is to unlocking the value in your real estate investments. We'll touch on interest rates, market trends, financial consideration. We'll try to discuss a little bit on where does rates impact leverage and leverage impact rate, whether it's a single family or a 10 unit or a 25 unit. I'll go to Mr. Joseph Martella. I haven't talked to him since prior to the convention, but Joseph, great referral to going to the expo. I thank you very much. But let's talk a little bit about the landlord, Mr. Landlord, and what he brings to the room, and then let's talk about a little bit. We had some bad unemployment numbers. We got job reports coming out, and we have some really correctiveness going on in the banking world, which I sent you some information. Let's get some thoughts on where does that lead to understanding and lowering risk with your rental portfolio loan.
Good morning, Joe. It's been a peaceful couple of weeks since we haven't spoken, so just putting that out there. But I'm glad that you had a good time at the Mr. Landlord conference. I wasn't able to make it to Columbus, Ohio, but I will be going to his Puerto Vallarta retreat in Mexico in January. Yeah, you're lowering your risk with the rental portfolio, which is the title, right? No matter what you do, there's risk out there, right? And we mentioned it a couple of weeks ago. We talked about adjustable rate mortgages versus fixed, and that's one way that you can lower your risk, right? I mean, if I bought a property, I don't know, 5 years ago with a lower interest rate and on ARM and did interest only, I'd really be in a jam right now with the interest rates going up. And struggling to find out how to refinance. I mean, yeah, values went up, but interest rates went up, and on my rents that I have, I have in place, able to support that. I mean, when you start looking at it, yeah, we could argue that rents went up significantly in that period of time, But when you have a long-term tenant in there that's been in there, I have a tenant that's going on their fifth year, right? And rents went up $600-700 a month on that place. You're not getting that $600-700 a month raise in the 5 years. It's an unconscionable raise to the tenant. Um, and if they challenge you in court, at least in New Jersey, they generally they'll win. So so even if rents increased and kept up with the pace of the interest rates, which are hovering what 7-8% now, uh, it would definitely prove a challenge. So one of the ways of lowering your risk is I go for the 30-year fix all day, every day, right? I don't care about the payoff of the loan, payoff of the house. Um, so the 15-year just isn't appetizing to me. Some people rather pay their properties off. That's not me. I go for the 30-year fix. The goal is as equity goes up, appreciation goes up, and and uh, and my loan is paid down. Every 5 to 7 years, I make cash out refinance, pull out that cash. It's money in my pocket, tax free, and then use that to invest into another property. So that's the ultimate goal. Obviously, there's a lot of other scenarios that have to play a role. You know, do the interest rates make sense? Does the economy make sense at the time? If the answer is no, well, then you don't go for it. But at least I know that my mortgage payment, at least the principal and interest portion, right? Because taxes and insurance always go up, as we know. But at the very least, the principal and interest portion will remain the same in that mortgage. And it'll remain the same for the next 30 years. So that's really one way of lowering your risk in a rental portfolio.
So, Joe, I got a question for you. So,
Yeah.
how concerned are you leaving money in a deal, and how do you evaluate the return on the money left in a deal, whether it's a down payment on a turnkey or money into the deal from a renovation perspective? How do you evaluate recapitalizing that money in your loan over time, right? Is it a 12-month, 24, 36 month? What's in your mind, you buy something, you put 25 or 20% down, right? You put 10 to 15 grand into the place to reset the place from a value add and deferred maintenance perspective. Where are you thinking as a single family investor on the return of your money over time? And what should that return look like also every month? There's a cash on cash and then also a return on your investment over time.
You want me to give away all my secrets, don't you?
Of course.
So listen, every investor is different. So I'm speaking from my vantage point, right? So the very least, and I don't have any stats. So I'm not a statistician in any way, shape, or form, right? I like to see at least a $400 a month cash flow. That said, when I'm looking about cash on cash, I'm not too concerned about leaving cash in the deal. I know a lot of people say, well, then it's not a true birth. You're not pulling 100% out, and that's all hogwash. The reality is that you got to look at the cash that you're using to invest, the cash that you're leaving in the property, and what's that return, cash on cash return, of course, right? So when you start using leverage, um, that cash on cash return goes up. So, for example, if I go and I buy a property cash, generally all the numbers that I've done on all the properties, you're looking at a 10 to 12% return, right? And and that to me is not sexy, right? I could earn a 10 to 12% return doing private money lending and not have to have any other risk besides foreclosing on a property. But I wouldn't have to do any maintenance. I wouldn't have to do any management. I would also argue that I could also lock my money in the bank right now and get 5 to 5.5%. So now I'm really only making an additional 5% of my money. Is it worth taking all that risk on for an additional 5% of my money? So those are two ways that I look at it. Right, wrong, or indifferent. People will have their own opinions. It is what it is. So if I'm leveraging my money, and I don't care if it's 20 or 40 or 50,000 in a property, but if I'm leveraging my money and my cash on cash return is coming back at least 15%, I'm okay with that. That means, you know, a lot of my properties get closer to 20%. So that means within 5 to 7.5 years, my principal is back in my pocket for reinvestment. I mean, you could also look at it that that money is just a long-term CD that's sitting in there for 30 years, just giving you a 15% return on your money. Now, granted, that's barring any maintenance, right? Moving on down the road. The $400 a month, well, I just pulled that out as an arbitrary number that makes me comfortable. It gives me $4,800 a year. So if you do have maintenance on a property call, listen, I mean, yeah, you have small maintenance here and there, and I've had jobs done as low as $50. But usually, more significant maintenance, you're not getting anything under $1,000 done, right? So you look at, you got 4 calls. God forbid it's a bad year. You have to catch up with things. You know, you're not going to be underwater if you have a couple of repairs. Or a water heater goes for $2,000. Granted, it lasts 10 months. I just had a 4-year-old water heater go, and of course, it wasn't covered under warranty. So um, things happen. Things happen that you can't that you just can't anticipate. Right? A roof could go on, and it's a 30-year roof, and in 5 years it starts leaking because something was done wrong, and of course that contractor is nowhere to be found. So you need to be prepared in order to have uh, repairs done. I mean, I have another investor that he and I debate all the time. He says, "Oh, well, all my rehabs are new, so I at least have 5 years of maintenance free." And I would argue, based on my experience, that that's not true. So you need to be putting money away and at least have a significant or a good amount of money every month.
Thank you, Joe, and thank you for giving away all your secrets on tape and on replay. So I really appreciate that. So, hey, Joe, give a little insight about your group that you have every first Wednesday of the month with SJI. So anybody that wants to come in and meet with you the day before, the day of, maybe they can set up some time with you.
Yeah, so we have a group. Marcus Williams and I have a group called Dinners and Deals with South Jersey Real Estate Investors Association. It's the first Wednesday of every month at the Westmont Diner. And it's really an open forum, kind of like this, right? You're a little bit more structured than our forum, but it's come one, come all. We've had investors. Joe is a frequent visitor, so I get to see his mug there. But we have from private lenders to DSCR lenders like Joe, asset-based lending like Joe, to novices. We've had someone with 600 plus units join, and it's just an open conversation on how to handle issues, and it's just. I would argue it's more of a mastermind mindset where everybody just kind of pours into that one issue and answers all the questions. We just had it this past Wednesday, and it was a pretty good and solid discussion. And we usually start around 7 o'clock, and people usually stay well beyond the diner closing, which is 9 o'clock. So, and then we take it to the parking lot and talk.
Thank you, Joe. Noted. I really appreciate you being here this morning. And well, again, from what Joe's talking about and what I saw at the Landlord Expo, we need to embrace leveraging technology, utilizing property management software and financial tools to streamline operations, track performance, and make data-driven decisions. They had an entire 3-hour course on artificial intelligence to the new wave tenant and what they're looking for. And this is the scary part. The institutional investor that's building out these multifamilies, these build-to-rent townhome communities, they're stepping up and having all those bells and whistles to dummy down and lazy the tenant where they feel right at home and they're going to stay there longer term, less vacancy concerns, and a better environment where they're not going to have heavy deferred maintenance. I mean, again, I had a discussion with a real estate broker on Saturday where he was saving the potential tenant $250 a month, but because he gets free coffee at the facility that's down the block, he'll pay more because he gets free coffee every morning. I mean, that's kind of insane, but I mean, it was kind of crazy just to hear that. I mean, the guy was like, "I'll give you a Keurig." You know what I mean? What else do you need? You're saving $250 a month. But that a potential tenant didn't see it that way. So there's some little bells and whistles, especially in AI and leveraging technology, you need to embrace with either software keypad entry or video protection to your property. And that leads me to Miss Amy there. Good morning, Amy. Welcome. Brief overview, who you are, what you do, and some thoughts to recapitalize and lowering risk with a rental portfolio loan.
Good morning. Yes, thank you for having me. I thought you were teeing me up, so that's wonderful. I am Amy Palvido. I am the founder and CEO of Facilimax, which is a data aggregation platform that makes real estate investing more profitable. And I'm also the chairwoman of the U.S. PropTech Council. So yes, on your topic of AI, if we're going to talk about how we lower risk, there's recapitalizing obviously is one way to do it, but there are a lot of new, even not just on AI. You want to talk about risk management. There are IoT devices out now that can basically remove the risk from fires and water leaks. And those are the two biggest calamities that will happen to your property, other than tenants, beating up on the walls and stuff. You can't do anything about those. But basically, if there's a water leak from a water heater or a sink or whatever, there are IoT sensors out now that if you install those on your properties, it will shut the water off as soon as it senses a leak. And so it will minimize the damage. There's also the largest cause of fires in housing are kitchen fires. And they come from usually from the stove. So there's an IoT device out now that will know that if the stove has been on too long, and it will cut it off to minimize those fires. Now, obviously, we went for Joe because he cooks a lot, and so maybe that might not work for him. I'm just kidding. But they have reduced the number of kitchen fires. They have not had one fire ever since they've had one of those installed. So it's actually pretty cool. So there are a lot of IoT sensors out now. Some use AI, some don't. But they as far as risk mitigation, that's where you're going to get your bang for the buck. And the good thing is that you can combine these or even use one or not all of them, and you can get insurance discounts from using them. So we have a whole risk mitigation thing on our website. It's facilimax.com. But if you are looking for those, we have a package around risk mitigation. So if you're looking for those, just let me know. And let's see what else. Oh, I could talk AI all day. You just let me know, Joe. I mean, I could keep going on all the cool things that are happening right now. It's super cool.
So I got a couple questions then for you, Amy. So based on what you're talking about, obviously you mentioned insurance savings. I have a public adjuster that's local to my market that will do a complimentary underwrite of insurance policies to make sure you're not overinsured or underinsured in case of something comes down the road. Is there something like that you offer through your AI where they can underwrite or evaluate the insurance policies to better understand it? Somebody that owns 20 properties might not be insured correctly across the board. Is there something out there that you're aware of on the insurance space? Because I'm seeing insurance almost to the point of monopolization and throwing debt service way off in some states. Do you see anything coming down the road in like an underwriting tool to see if you're under or overinsured on policies?
That is a really cool thing, but what I find especially on the commercial side, is it's really mandated by the lender. Your insurance and what you have to have coverage for, your lender basically dictates from you.
Correct.
So, I don't know if there is something like that. But I am going to InsurTech, so I probably would find it there if it was there.
I'd be so interesting to find out because, think about it. Like Florida is in a nightmare insurance environment. Texas is a nightmare.
I know.
And then software. I mean, the guy and gal that owns only 5 properties, is Buildium really the best software to use, or is there other Buildium like softwares? You know what I'm saying?
Yeah. Yeah, so there's I would say Buildium is not. I would say if you're managing a lot of single family rental portfolios, Propify is probably your best one because it's built for just single family rental portfolios. It's what it's built for.
Yeah.
And it so it can manage the, desperate, I mean, all the different locations you have and all different properties that you have. That's super cool. I think the far as the AI is coming on so strong now in the whole like lead generation and tenant qualification piece and all those different things that it's becoming. And I was even talking to someone yesterday where they're applying banking methodologies on qualifying tenants, which really hasn't been done because everybody, I don't know if y'all know, but if you've ever qualified tenant, TransUnion just sucks. I mean, it doesn't capture everything that you need, but they're using AI to kind of not only it's the whole life cycle of the tenant. So not only is it on when they give you an application, it's they can monitor them. The tenant agrees, but they can monitor them. They'll tell you and give you a red flag. Oh, hello, this person might not be able to pay their rent in 3 months, right? They'll monitor their bank account. They'll do different things like that. That's just super cool to me, right? And you'll be able to like forecast your renewals better, and different things like that because the tenants will allow them to kind of get into this their banking information to kind of see how they're able to pay the rent or not be able to pay their rent. It's interesting. I mean, it's interesting, wild world of what is happening with AI at the moment.
And last but not least, you got a couple of webinars coming up. Briefly, let us know when and where and how to find you.
Yeah, I will. I do, and I'm pulling it. So the U.S. PropTech Council, by the way, has a ton of webinars, and if you go to our website, it's called PropTech Council, PROPTECH, council.com. We have a ton of them. And we have one on coming up at the end of the month on blockchain, but we'll be having more and more of these and producing more content. But the website's the best place to go where you can get all of that from. I also have a podcast called PropTech Genius, which I push out pretty much almost every day or 6 days a week. I'm pushing out interviews. I interview PropTech folks. I interview real estate folks. Joe, you should come on the show. It would be great. And it's really kind of interesting. But the PropTech Council is fairly new. We just started this year, but we're just growing like wildfire. We have 800 members already in 4 months. So it's growing like crazy. But I will let you know the next webinar I have is June 25th, but it's all on the website, proptechcouncil.com.
Thank you, Amy. And please put that in the chat if you don't mind. And so people, so people can see that, that'd be great. So, from some of the things I've listened with Amy and conversating here, I think professional property management, when you get to a certain point, is going to be necessary. You're going to outgrow yourself from a self-managing perspective. I think thorough screening processes need to be implemented. This reduces risk of tenant defaults and property damage. Comprehensive, Amy, do you mind miking? So comprehensive insurance coverage, ensuring the properties are adequately insured. Maybe sit down with a public adjuster to evaluate your insurance policies. I know there's mandates by the lenders ourselves, but these are things you need to really think about. And then also, we didn't touch on, but proper reserves. What are the reserves that you really should have in place? What type of lines of credit should you have in place, whether it's personal or business? I'm a bigger fan of business lines of credit. Now, I have gotten more calls in the last 30 to 45 days on second position inquiries, meaning people looking for a second position loan on a current loan. The first place you need to go to always, if it's with a local bank or credit union, go back to that same one because they're the only ones that are going to allow second position debt on that property if there's room. No one's going to over leverage an asset knowing they can't recover the second position if the values are indifferent, meaning they're not going to give you 90% loan to value between the first position loan and a second position loan. It'll never happen, ever. So your option is either to look at unsecured business lines of credit that don't impact your personal credit when you need that money and consider that as part of your reserves, Also, right now, asset-based lenders are providing up to 70% recognition of your cash out as reserves. I'm going to say that again. If you're doing a cash out refinance, an asset-based lender should be recognizing up to 70% of that cash out toward reserves on that subject property. Now, the problem you have here is that back in the traditional lending landscape, you had the 10 mortgage rule, and they took your personal income into account. What if you lost your job or left your position? Your debt to income might not match up with the profitability of those properties because they were using your personal income to evaluate the income production of that property. So it was skewed. The difference in the asset-based lending, they don't care about your personal income. They care about the asset, the individual asset or the multiple assets that you're trying to either purchase, refinance, or value add from a fixed to rent or fixed to flip. Justin, good morning and welcome. Brief overview, who you are, what you do, and thoughts to recapitalizing and lowering risk with a rental portfolio loan.
Yeah, good morning, Joe. Justin Denver, in between the Louisiana market and Dallas market right now. But as far as my resume, I've done several fixed and flips, and I am strongly stepping into the official world of development. But you know, definitely hear a lot and enjoy these discussions. So, recapitalizing and lowering your risk. Well, Joe, when I feel like once you've and I'm gonna kind of keep this part short and sweet. Once you have established a cash flowing product or a portfolio that cash flows over time, that portfolio is gonna um, need some maintenance over time. You may want to increase your opportunity, and you may want to invest in some other things. So as you pay down or as you pay up some of the equity in that property, build up some of the equity over time, it's not a bad idea within a couple of years and with a strong strategy for you to put a new set of financing on that property, maybe take a little bit of that cash off top and reinvest that capital into something that could push you further towards your life goals as far as the financing or whatever your investment goals are. So it's a way that when you're building it, like I said, when you're building up your portfolio and you're ready to stretch it a little bit further, you pay down some of your expenses and the debt that you owe. It's a good way to push yourself forward to the next level. But I also wanted to kind of mention that when it comes to the rental portfolio and stuff like that, I heard you guys talking a little bit about maintenance. I just want to kind of add my 2 cents in on that. I think where we are, Amy was touching up on a lot of technology and a lot of that stuff, which kind of helps me lean into my point of the newer construction property or building a property from the ground up and putting it to market, whether you're putting it to market to sell or you're putting it out for rent. I like that way of doing things in this day and age because I find that people are less willing to deal with older properties at the pace at which we move today in society. So much has changed. We use things 10 years ago that were brand new that are obsolete now, 5 years ago too. So and like I said, at that pace, you need to have technology input and built into some of these things. And the way we're going, it sounds like I'm sure that some of the technology Amy was mentioning as part of. You don't need that. You can put it on any building, but I would imagine that it might be easier to incorporate into things as we go into the future. And all of those, to me, are signs of an easier transaction, right? A more demand when you want to for your exit strategy when it's time for you to go on to the next thing. So, and it gives you a stronger refinance, right? You will appraise better when you have things that work together seamlessly and can work together with the work well in the direction that we're going in this world. So I just kind of think about that, and there are a bunch of ways to do it and make it make sense. But just wanted to throw that in there based on what the topics is going to go.
No, you hit it right on the head, Justin. I don't think we emphasize enough of building a backup bullpen to maintenance and GC uh, players to have available. Like I have a top client of mine that's always looking for a painter. Always looking for painters come and go. He can't find a painter to stay consistent. Funny enough, I'm at a local event and I see this young lady walk in. She's got paint all over her hands. I'm like, I am assuming that the young lady is either a painter, and she came in like construction garb, and I'm like, are you a painter or a GC? She's like, well, I focus more on the painting right now, but she does light GC work and maintenance work. I said, listen, I have a top client has 5 to 10 properties a month he's buying. Do you mind if I make an introduction for you? She's like, absolutely not. Made the introduction. Hey, it's another person in this gentleman's power team. I don't think we take an emphasis enough and depend too much on one or two maintenance people. You need to have multiple. I mean, if you're not stopping by Home Depot in the morning at 7 o'clock or 6:30, 6 o'clock in the morning, grabbing a cup of coffee at the pro desk once a month, I don't think you're doing a good job with your properties in that market. Okay, or going to an industry type of an event where there's GCs and service providing companies there to kind of just sharpen your tools. Like I go to a meet the developers event once a quarter because there's third party maintenance and service providers there, and I've made some great introductions to a lot of my clients because of that. Like I now have a GC group in Philadelphia that they'll go in there and do some. They have crews and they're looking to afford the work, and I vetted them. I'm doing work with them already on the loan side because a lot of these general contractors are waking up to the opportunity of asset-based lending to leverage to buy and renovate properties and hold them for themselves because they control their costs on how they're buying correctly. So your GC is your new competition as a real estate investor if you're not a GC. So you better learn how to link up with multiple GCs and multiple maintenance groups to stay very ahead of the deferred maintenance issues to properties, because the average home in the United States is aged at, I think it's like 1954 it was built. I don't know about you, but have you ever met anybody that was born in 1954? How they look at? They need maintenance. They need an oil change. They need a little upkeep. You know what I mean? So just some thoughts to that. Good morning, Bob, and welcome. Thank you for your patience. Brief overview of who you are, what you do, and thoughts to recapitalizing and lowering risk with a rental portfolio loan. Bob?
Hey, good morning, Joe. Yeah, I'm here. Can you hear me?
Yep.
Hey, so good morning. My name is Bob Chesick. I'm president of Chespin Corporation. I've worked in the incorporation and registered agent industry for about 22 years now. I'm not a lawyer, so I'm not here to give you any legal advice. And I don't work in loans, but I do get a lot of questions, particularly from LLC owners who have LLCs for real estate investment. And the biggest question that I get asked about this when someone's either trying to form an LLC to get a loan, or because they have multiple properties, they're trying to refinance their loans or whatever. And their question basically comes down to, and it comes down to risk, but more on the personal side, is does the LLC absolutely shield you from the liabilities of the loan? In other words, if your LLC defaults on the loan, are you stuck personally with it, or does the limited liability take that out of the way? The biggest thing I can say about that is read the terms of the loan, because a lot of times when you're getting a loan, unless you've got stellar credit within the business, so the early stage LLCs are not going to get this, or even early stage corporations. When you sign the loan, if you sign a personal guarantee, you're not piercing a hole in the corporate veil. What you're doing is you're effectively constructing a bridge or a bypass for the lender, that if the LLC or the corporation defaults and cannot pay its loans or otherwise goes bankrupt, that liability can shift to you, or it could be joint and several, meaning that both the owner of the business and the business itself are on the hook. And technically, they can go after either one of them, depending on the terms. So always be careful of that. Now, if you're newer in the game, you're not going to be able to get that loan without signing that personal guarantee. It's just the way it is. Very few lenders are going to look at a brand new day one LLC, and I'll leave Joe to comment more on this. But
when you look at a day one LLC and they're like, oh, you just formed this 5 days ago. Okay, and you want a loan, they're going to make you sign a personal guarantee. Pretty much can guarantee that. Pardon the pun. And that's at least what I've seen in my 2 decades plus with doing this. But that does not mean in any way that it's necessarily a bad thing, because especially in the early days of forming an LLC, you'll probably find that that's actually the stepping stone you need to get to build the credit, so that in the future, as you're going through recapitalization and refinancing loans, that you might be able to remove that, especially once you generate positive cash flow. Another technique that I've seen people use in that regard, now this only really works if you have multiple properties with it, and that is to set up a holding company and have subsidiaries under the holding company that own the individual properties. Because the holding company, which could also be a management company or an operating company, depending on how you and your attorney decide to structure it, and every structure is unique, that company might be the one that's taking on the liability for the loans, basically creating an extra step between you and your properties. It's a more expensive method to follow, but ultimately, as you grow larger, that's probably the method you will fall into by default. And sometimes shifting the liability there would allow that parent company or holding company to build up the big credit, and then being able to disperse that money to its subsidiary LLCs as they see fit. You should never try to do that method without an attorney or an accountant guiding you, because I've seen people try to hack that method, and then 2 or 3 years later, I can't even get the registered agent fees out of them because they're absolutely broke and they have the lenders coming after them. So be careful with that strategy. Make sure you have your power team in place before you implement it. But I've also seen people implement it with the proper power team, and they're making big money right now, even in just a very short couple of years. So just my 2 cents on the topic. With that said, again, that was not intended as legal or tax advice. Joe, back to you.
Bob, thank you. And 2 questions. What is the biggest mistake you're seeing with the newer investor with an LLC? And 2, I know we briefly discussed via text a subject that we're going to put out when time is available in regards to the laws looming coming up in regards to the LLC. Bob?
The biggest I'm here. Sorry.
Yeah.
The biggest mistake I see is, frankly, people taking shortcuts because they're trying to do it as cheap as possible. And I don't necessarily mean that I'm trying to charge some astronomical fees. That's not where I'm going with this. They're like, oh, well, I'll get an attorney when I need one, or I'll get an accountant when I need one. They have no clue what they're doing, and they're trying to hack it. And I'll usually get clues on that, because I'm not going to quote prices on here, but relatively speaking, if you look at my prices versus what you find online, my firm's generally a lot less expensive, or at the very least on par with some of them. And they're saying, well, is there any way I can cut some costs or cut some corners, or maybe I can do that step on my own and all that. And then inevitably, a week or 2 later, I get that panicked email. Hey, I've got a question. Well, I'm not going to help you with something that you refuse to pay me for. If you went and did it yourself and you made a mistake, now you have to get a lawyer involved or an accountant to fix that mistake. Because you told me flat out you don't want me touching that paperwork. Okay, that's fine, but that's on you. And to your other point, it's not a looming law. The law is here, and it's the Corporate Transparency Act. And we'll have to schedule a room in the upcoming weeks for this. But generally speaking, every single LLC, corporation, or entity registered with the Secretary of State on or after January 2nd, 2020, is required to file what is called a beneficial ownership information report with a government agency called FinCEN. You've probably never heard of them if you're not in the lending, well, at least if you're not in the banking or securities industry. But it's part of the National Defense Authorization Act of 2021 and the Anti-Money Laundering Act. It is a national security law, and if you do not file this report, new companies, you have 90 days if you formed your company in 2020. Companies formed prior to 90 days if you formed a company in 2024. Excuse me. If you formed your company prior to this year, you have until January 1st of next year. If you fail to file a complete report, which includes the names and addresses and driver's licenses of every beneficial owner of the business, and beneficial owner doesn't necessarily mean an owner. It's a really weird law. As well as declaring where your physical records are kept, the EIN number of the business, and a few other details, you can be fined $591 per day of noncompliance, and that fine would go to the senior officers of the company, and a criminal liability can be attached with a $10,000 fine and 2 years in federal prison per occurrence. Now, one word of caution, if you Google this law, you're going to see that a federal court said it's unconstitutional. That was a very limited ruling that only affected a small group of plaintiffs. The law it's real, it's in effect, and it is enforceable at any time. And FinCEN, by the way, is an agency of the United States Treasury Department. If anyone has questions, I'm going to put the link in the chat where you have to file the report. But if anyone has questions, give me a punch in the face here. You'll see my email and my phone number, and you can call or write me with direct questions until we do the room. I don't want to take too much time on this.
Thank you,
But I'll
Bob.
put that link right now.
Yeah, Bob, just let me know when you want to put that together, and we'll make that so in the upcoming Saturdays or Sunday, whenever you're ready for that. And I appreciate your insight. I've known Bob 14 years, and he's been part of my power team for 14 years, and I keep leveraging him week in and week out for my clients, and very good results and really good communication with a lot of my clients. And he weeds out all the bullshitters, to be honest with you. I don't got time to ponder with somebody about their LLC. If they're not ready to make a move, he's actually a very good litmus test for me, sending somebody to him if they're not taking it serious. And this is where, continuous market monitoring, keeping abreast of market trends and adjusting strategies accordingly. This includes rent adjustments, property upgrades, or divesting from declining markets, rent optimization, using data analytics to set optimal rental rates that maximize income while remaining competitive. What's your competition look like? What's the relative market look like? Do a financial review on yourself and the LLC, and implementing these strategies, conducting periodic reviews of your portfolio's financial health to identify opportunities for recapitalization or risk mitigation. Travis, good morning and welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning, recapitalizing and lowering risk with a rental portfolio loan.
Hey, Joe. Yeah, I'm Travis. I'm a real estate broker here in the Florida, Houston area. And I wasn't ready to start talking. So it's all right. I'm just going to go back in the audience and listen for a while.
No problem. Well, thank you for being here this morning. Thank you for listening in. So again, we're here to sharpen our weaponry in being the better landlord, being the better service provider for a landlord. There's different pieces of the pie that you could play in this to help lowering risk and creating opportunities for your power team, for your clients who are potentially investors, you being the investor, identifying the right investor. I'm finding my strongest investors right now are not leveraging past 70% loan to value. One, because they're getting the best rates available to them. But two, they're leveraging good debt. People have a lot of bad debt, and there's a lot of people that have good debt. Good debt to me is when you're not over leveraged and you're making 2% on your money via debt service coverage ratio. And that's where they feel comfortable. You don't always have to go with the 75 or 80% leverage because you learned it on YouTube. Okay, that doesn't make a lot of sense, because if you're losing 8 to 10% value over the next 3 to 5 years, and you're looking to sell that property off, you might be break even on the property based on debt that's in place. So be smart when you're working with somebody to how to leverage your debt to the value of properties. Values are coming back softer by 8 to 10% right now. I'm seeing it every day. I closed close to 42, 52, I don't know, 50 something property doors last month. And yeah, all the appraisals came back light, except in very specific markets that are where migration rental reports are moving up. So understand where migration is and rental opportunities are, and maybe thinking outside your immediate market, being that out-of-state landlord, but you still got to build that team out. Good morning, Melissa. Welcome. Brief overview, who you are, what you do, and thoughts to the discussion this morning, recapitalizing and lowering risk with a rental portfolio loan.
Good morning, Joe. Good morning, Clubhouse. I liked that segue right there. So I am actually a part of a power team. I'm Melissa King, owner operator at One Last Eye LLC Virtual Assistant Services. One Last Eye is a realty, bookkeeping, and admin professional that can help you with your real estate bookkeeping and business and office management. I'm also a notary here in the state of Michigan, as well as a licensed referral agent. I want to say, as far as risk mitigation, and part of your power team, that's going to include a bookkeeper or a CPA that offers the bookkeeping for you. I consider us professional gatekeepers. We help protect you from overspending, maybe even some destructive spending. You can see where your income and your expenses are going every month, as long as you're reviewing our deliverables that we give to you. And it helps us disseminate your data to help you get organized and reduce your chaos. I know we can take advantage of chaos, but in order to do that, you need to know where you're at. Isn't that true? Amy, I have one question for you as I heard you go through that with regards to property managers being able to forecast a tenant's ability to pay rent and then notify them. I just see that as a little problematic because I know a lot of people, you're going to have to, don't you think you're going to have to tell these people and really protect yourself? Because just getting an authorization from them, I mean, people don't read. They'll check the box and say, hey, yeah, no problem. You can go into my bank account and check, see if I'm going to pay rent until it comes right down to it. And then they realize what kind of authorization they just gave to their property manager. That scared me a little bit when I heard you say that. I mean, I can see it as a tool, definitely, but I don't know if it's a privacy issue or not.
Well, it's not privacy issue if they sign an agreement saying that you can do it. So
I think that should be tightened down.
Well, I'm sure it should be tightened down, and I'm sure there'll be laws that come around to it. But it's a startup that is gaining steam here, and it probably will be dependent upon states' regulations and laws, and that they will have to comply with. But they comply with them just like any bank would, right? So it's not my startup; it's a startup that's in our council. But I mean, there's going to be more and more tools that you can use to qualify your tenants. But I'm looking for more of it as a life cycle of the tenant and getting insights in as a landlord to understand who could be a problem. It's not like you're contacted them going, hey, we see you have $5,000, but you haven't paid your rent, and it's not for that. It's for insights into who flag and signals for problems down the road. That's what it's for. So it's not peering into their bank accounts for that reason. So they have to comply with certain banking laws.
Oh,
so they're,
absolutely. I came out of the banking industry, so I
Yes.
absolutely get that.
yeah.
What if, well, let me throw this one at you. If they're a commission-based tenant, I mean, that cycles. That's not real. They're not getting, every month.
Yeah, no, I understand. I mean, I get it. I
Okay.
understand. Yeah, like I said,
That's the first thing that came to my head.
Yeah, I mean, it's like I said, it's not my startup, but it's they are in the council, and I just thought it was a really cool use of a way to forecast problems if there are going to be problems. I mean, the landlords get, so what happens as a landlord is you get sideswiped by somebody who's probably been paying on time. And if you could have looked for a signal of that they might be skipping or leasing, and it could be just like, hey, they pay on time every month, but it's always like on the 7th. Well, when they start to deviate from that pattern, we want to know, right? Because that's a signal to a landlord that there might be problems on the horizon, right? It's just about getting signals so you can understand and manage your occupancy better. That's all.
Oh,
because
yeah. And a lot of property management software programs out there do already do that because you can see those metrics. If they're late consistently or they're paying only on that particular day, heck yes, you want to look at those. Because those are the problem children.
Yeah, but they don't do the signals as far as the deviation. Not a lot of them do that yet. So some of them are getting better, but not all of them do. Building doesn't.
Appalachia doesn't.
Well, right. There's a lot out there.
Yeah,
Interesting.
but
I wonder
but
if you put the code into something already.
I mean, there's data platforms that are starting to track some of that kind of stuff. Cherry's doing it, some other ones. But yeah, no, I mean, but the whole thing around insights into the tenant behavior is the whole point of that. And if you can get ahead of the curve on trying to predict whether a tenant's going to skip on you or they're not going to be able to pay the rent, or you can offer them some sort of assistance because you kind of see what's happening to them. That's always a good thing, right? Because you can.
Oh, I like that last part. Yeah.
Yeah. I mean, if you can do that. I mean, landlords want to do that. They don't want to do a turn. Turns are expensive. I'd rather keep a tenant there. But if I can find some way to help them, by getting a signal going, hey, you've been paying late. You usually pay on the 7th, but now you're having to start pay the 10th. And last month you had to pay on the 12th. What's happening? What's going on? Can we help you in any way? Right.
Right. And people don't always ask for help. So, okay, I get that. I see that.
You with me?
Okay.
Yeah.
Yep.
Okay.
Absolutely.
Alright.
Thank you.
Thank you, ladies. We worked that out. So, Melissa, my specific question to you that ties into, lowering the risk. Where is the biggest miss in bookkeeping where I feel you need the bookkeeping to buffer yourself to the CPA before you put everything together? So I'm going to give you some like bullet points, and you let me know where the biggest, weakest point is for one of them. Okay, like one that stands out to you. Keeping personal expenses separate, itemizing all transactions, categorizing expenses, tracking receipts, reconciling monthly review, create accurate reports, track expenses, and understanding tax forms. Where do you see the biggest miss for a real estate investor today that stands out?
Trying to do it yourself, trying to hack it yourself, trying to fix it first. And then you get in over your head. I mean, I've had several new clients just in the last 6 months. They tried to do it themselves. They got overwhelmed. They weren't, they really don't know how to itemize. They don't know what to itemize at first. And if they can actually get in front of some P&Ls for that particular business, property management, your note investing, whatever, then they'll be able to see. A lot of people, biggest mistake is they try to do it themselves. And then they find it's overwhelming. And then by the time they get to a bookkeeper or a CPA, same thing. They don't want to pay those upfront fees. I mean, because it is going to be a lot of money to set that up. But I mean, just like a good insurance plan, it'll save you in the end.
Thank you, Melissa. Some factors you need to keep in consideration from the conversation I'm hearing today in recapitalizing a property performance, market conditions, investment goals, tax implications, and potential risks. Good morning, Ronald. Welcome. Brief overview, who you are, what you do, and thoughts to our question regarding recapitalizing and lowering risk with a rental portfolio loan.
Good morning. I would like to start with a thank you note to you, Joe, and Linda for arranging so many events in Philadelphia, New Jersey. I really like participating within your event. The question I have is about managing risk with regards to rent increase approval process. So the question is both to you and Amy, is that how can AI help landlords with targeting rent increase percentage across the area? As for myself, I invest in Strawberry Mansion area in Philadelphia, Section 8, mainly single house. And the issue that I'm having currently is that I got a message from Section 8 that they are still having a backlog of approval for rent increase applications are made. That's the backlog started from 2020, and right now they're processing just July last year, 2023. So definitely I'm falling behind in a rent increase, and I would like to know, is this something in Section 8 Philadelphia particular issue, or this is like across the nation, the Section 8 is falling behind?
I'll add something, then I'll see if Amy has any input. In regards to Section 8, obviously HUD increased Section 8 numbers across the country by 20%, which changed the market rent in every urban city in the country. Okay. And what it created was an influx of landlords saying, hey, I want to take all my units Section 8 in lieu of staying in the market space and taking my chances with professional tenants. Now I've seen better results in the suburbs or rural markets surrounding the cities, but the cities are so backed up because everybody wants a Section 8 tenant because it's guaranteeing somewhere between 80 and 90%, or even sometimes 100% of the rent. So just imagine you got a 5 foot hole, but you got 100,000 inquiries, which is 20 foot wide, trying to get into the 5 foot hole. It's very tough for a government controlled agency to keep up with the changeover and the increase of Section 8 inquiry, because now Section 8 is better than most of the market rents in a lot of the neighborhoods, specifically in a city like Philadelphia, across the country, all at the same time. But I'm seeing better results like in the counties, Delaware County. I'm seeing it better in Montgomery County. This is better operations. So the operations are better. They're able to stay abreast of the Section 8 increases and are able to facilitate the landlord. Philadelphia, like any other big city that runs it like a state, they're behind and they're going to stay behind. Amy, do you have any input or maybe some? I mean, I'm seeing AI having complete communication with tenants now, based on what I saw on Saturday.
Oh, sorry.
Yeah.
Maybe it's just me. Yeah, no, using AI to determine rental increases, I will just caution everybody. There have been a lot of recent DOJ indictments with Yardi and probably 18 of the top property managers. And there was just a raid by the FBI on Cortland, which was using real pages. It was all around there. There had this AI tool that Yardi had and RealPage had that was helping apartment managers set prices, right? And what they happened over time was that those apartment managers took it to the extremes and were setting these prices based off of this AI tool, and they weren't. It wasn't like there was no discretion upon the apartment manager on whether to do that. And so they found that they were colluding. And so because they were including, they were price fixing and the rent. So I will caution you, do not say you're using AI with rent price. Just don't do it. I mean, even if you are, just don't say it. But the market surveys and a lot of the information, that's all it is. Like, you use a market survey. So you call around, everybody lies to you. I mean, I was an apartment manager for a long time, right? Everybody lies to you about what they're renting their stuff for, but you can use apartments.com to kind of try to figure out what the prices are. But as far as getting approvals from HUD, like to Joe's point, every housing authority runs differently, and some are better than others. When I ran apartments, I probably had 4 or 5 housing authorities I dealt with on a different basis, and there was ones that I liked and ones that were awful, and they just don't. There's no continuity in between them, and they all kind of run their own show. And so, but I did not know about the run on the Section 8, so that probably makes sense on what that's going on there. But just FYI.
Yeah, they're completely overwhelmed. It's kind of crazy what's going on in the city of Philadelphia as an example. But let me go back. Somebody requested for me to go over the items again to keep in consideration recapitalizing a property. Property performance is number 1. Market conditions is number 2. Investment goals are number 3. Tax implications are number 4. Potential risks are number 5. And there's support with your power team for every one of these items. And then you also have to look at the benefits of real estate recapitalization. Liquidity, very important. Increased property value, very important. Or maintaining property value is very important. Understanding debt optimization, what leverage fits what you're trying to accomplish. And then obviously risk management. Good morning, Linda. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning, recapitalizing and lowering risk with a rental portfolio loan.
Good morning, Joseph. I hope you're doing well. Good morning, investors. My name is Linda Pliagas. I'm the founder of Realty411.com. We're a news and information website for real estate investors. And we also produce virtual and print magazines, virtual and live events, webinars, and so much more, all in an effort to help investors on their journey. Now, as far as mitigating risk, in my opinion, the number one rule is simply don't bite off more than you can chew. Oftentimes, investors become so aggressive in their buying. It's, like they're in a hurry to acquire as many assets and rental properties as possible. And then they get over their head because they over leverage. So just because you can qualify for $1 million loan doesn't mean that you should get it unless you know exactly what type of property you're purchasing and you know without any doubt that you can manage that property. Now, one type of loan that I keep going back to again and again is the 10-year interest only loan. It is amortized over 30 years, but for the first 10 years, it's interest only. This is my personal favorite loan. And I recommend it, especially when investors are first starting out. The interest only loan will provide the lowest amount that you need to pay back every month, which will make it so much easier to fulfill your loan obligation. I've utilized interest only loans many times. In fact, right now, I have I have one interest only loan and I want to convert another one into an interest only loan because my cash flow will increase. And for landlords, cash flow is very important. That is, our business model to make as much money every month as we can to cash flow the property. Now, I probably, looking back at my investment career, I probably would not have been able to purchase some of the properties that we have acquired without this type of loan. So that's why I think it's so important. Now, usually the interest only period will last 10 years. And by then, normally you will have appreciation set in and you'll have a lot more equity on the property, which will make refinancing even easier. So you can refinance again with a lot more equity into the property, and you'll have much better term rates for that as well. So back to you, Joseph. Thank you.
Thank you, Linda. Can you give us an update on upcoming events through Realty 411 so we can note that, and if you could put anything into the chat as well?
Yes, thank you. We do have a virtual event on January 22nd. Everybody is invited. It's absolutely free, complimentary. It is an all-day event from 9 a.m. in the morning until 4 p.m. in the afternoon. You can come and go as you wish, and we're going to have a lot of different topics and a lot of different educators speaking on their expertise subject matters. And then for our in-person event, we are having an in-person event, actually two in Southern California. We're going to have a more intimate event on August the 3rd. We'll have an all-day event. We'll have lunch included, one station for education, and then we're going to have a much larger event on October 26th, where we're going to have 3 different breakout sessions and over 800 investors from around the country. And that is a one-day event as well. You can get all the information at realty411.com. And we hope to see you there. And if you can make our virtual event, please make it. We would love to learn with you virtually. And it's a great time. We can, you can listen to the speakers and also ask any questions that you wish. And hopefully we can have Joseph on, one of the virtual events coming up soon. Thank you.
Thanks, Linda. I really appreciate that. One thing we didn't touch on in recapitalizing and lowering risk is the value add when you initially buy the home to renovate. Like, you don't always have to buy something and gut it to the studs. That eats away time, increases risk, and then obviously the end result, by the time you stabilize the property, that value could be much different in 3 to 6 months than 3 months. Comps are working against you right now. There's not enough comps because home ownership sentiment is at an all-time low. So you really need to concern yourself in getting in and out of a renovation or repair. I really suggest in lowering your risk on buying the fixed to rent concept, keeping it under 45% of your purchase price. So if you're buying it at $100,000, reno should be no more than $45,000. Upgrading the kitchen or replacing the kitchen, upgrading the bathroom or replacing the bathroom, adding a bathroom, cleaning up the floors, maintaining the molding, paint, fixtures, some exterior work, roof, mechanicals, warranties to the mechanicals, warranties to the roof. These are things that will put a better deferred maintenance in recapitalizing a after repair value than ever before. Smaller, sleeker, in and out opportunities, restabilize, rent, move forward to the next deal, refinance. Mr. Martella, your outro and thoughts to the discussion. Recapitalize. Well, I'm sorry, Travis, did you have something to add?
Yeah, thanks, Joe. I wanted to go back to what Ronald was asking about Section 8 and what he's experiencing. So, I have properties in the Houston area that are Section 8, and I have properties in Mobile, Alabama that are Section 8. And I can tell you that what, some other people have already said is the housing departments are completely different. They're not all run the same. And my experiences with the housing departments here in Houston, as opposed to Alabama, is Houston's better than Alabama, but Houston, I'm still waiting 6 months, to get a rent increase. So this is just one of the things that people need to know before they say, okay, I'm going to go rent my property to a Section 8 tenant, because it's not all as glorious as people want you to believe, right? You're listening to these people online or wherever you're hearing them talk about it, but they're not even landlords that have Section 8 tenants that have dealt with the problems of the housing department, not necessarily the tenant. So I wanted to address that for Ronald. And then so you just said, Joe, about, properties that they're not appraising. And I would say that is real estate is hyper local. So, where I am, there's no problem selling properties. We're still selling properties within a week, and there's plenty of comps. So it's, if you've got a property that you're going to buy in Burr, or you're going to buy and resell, whatever, you better know your market and know what's happening around you.
Thank you, Travis, and you're correct. Yeah, you have to follow your migration rental reports and value reports. Texas is still very, very frothy, so I don't see problems with values there. I don't see problems with values in Florida right now. I don't see values in properties in North Carolina, South Carolina, Georgia. These are very specific markets that are making a lot of sense. I'm also seeing the values in Ohio coming in, that between $100,000 and $150,000 single family home. Yeah, that's a very reliable market. Columbus, Cincinnati, Akron, Dayton, Cleveland. I mean, they're having a little struggle there. They're playing a little catch up, but I feel like those 4 cities there in those immediate suburbia markets the values are working, the cash flow is working. And again, Section 8 is definitely case by case. It's not the make all to break all. I can tell you some people that stay away from it completely and they're happy with it. And I know some people that are getting completely entrenched in it and they're frustrated. And I get that too as well. Mr. Martella, good morning. Your outro and thoughts to our discussion this morning, recapitalizing and lowering risk with a rental portfolio loan.
Good morning. So, going back to the Section 8, I have a couple of Section 8 rentals. I've had zero issues with them. I mean, dealing with the state employees is a challenge at times, but as far as getting that set up, once you're set up, you're fine. Going back to the loans, the interest-only loans, and I put it in the chat, right? I don't know what rates were 10 years ago, but I know what they were 5 years ago, and you're not paying into anything to the property or the equity. So, your strategy is hope. You hope that the interest rates remain the same in 10 years. You hope that your property appreciates. In 2008 during the GFC, that wasn't the case. Right now, interest rates don't remain the same, but you have appreciation. You just got to hope that your rents stay up with that. So, again, I would debate anybody on the interest-only loans all day, every day versus a 30-year fixed or even 15-year fixed. Because you're talking about mitigating strategy and mitigating risk in with a rental loan portfolio strategy. And mitigating risk is actually knowing what your expenses are. So you can actually predict what's going to happen in 10 years. On an interest-only loan, you can't predict. So hope is never a good strategy when you're doing a rental portfolio and all you're doing is increasing your risk. So when you're mitigating your risk in a rental portfolio, you try to predict as much as you can and try to put as much aside, or at least have a reserve to handle any maintenance that comes up. So that's where I stand on it, Joe. Great room, good information. Hope everybody walked away with a couple of good nuggets that were out there today.
I think we touch on a lot of different pieces to get yourself across the creek. We threw a lot of stones down to kind of step across. We gave opinions on direction, structure, bullet points of how to, some nuggets where you kind of have to take a really deep look with your rental portfolio with different professionals in the space, whether it's bookkeeping, lending, real estate agent, AI, property management, GC, maintenance work, insurance, public adjusting. There's a lot of different moving parts. You have to hone in and build that team for balance and security and lowering the risk at always. This is ongoing. It's like taking care of your health. It's not one day a week. It's every day. Every day you're supposed to drink a certain amount of water. Because every day you're supposed to eat a certain type of protein or carb. It's the same thing. You're maintaining the health of your portfolio and constantly recapitalizing value or maintaining value, lowering risk, keeping good tenant-landlord relations. These are all very, very important factors to be a successful real estate professional. I want to thank everybody this morning. Very engaged room. We are the only clubhouse room that has their own podcast at creativebirdstrategies.com. We offer also marketing and video work for our listeners or engaged professionals and moderators. If they'd like to have one, we can help promote a video introduction or an interview through our podcast. We're hitting close to our 50th episode. We offer real estate evaluation tools for you to better strategize and evaluate your deals or future deals. We now offer CE courses for licensed real estate agents in now 45 states. We have the first one that rolled out, which I published, which is on navigating asset-based lending, which offers 3 credits CE to licensed real estate agents. And then I'm rolling out a new one that I'm publishing by September, wholesaling real estate for real estate agents, which that'll be hopefully a really good one. We're working on it now on the approvals through NAR and the school that I have my licenses with. And then we obviously have a lot of live events throughout the country through Realty 411. And I want to thank our sponsors as always. I'd like to thank Lendmark Capital, where I work as a senior loan analyst on asset-based lending for a single family through 25 unit, fixed to rent, fixed to flip, DSCR, new construction. I'd like to thank MB Capital in regards to unsecured business lines of credit as a referral program. Please let me know if you have any questions on that. I'd like to thank Realty 411 with Lina Pelagas in regards to her national real estate publication and her national events with real estate professionals throughout the country. And I want to thank always Perkatech with Yordale Perkins, our social media strategist, as I call him, the Oz behind the drape, that provides all this for us every weekend and provides social media strategy for real estate professionals throughout the country. So set up an appointment with him. That's a call to action. And a call to action, all these moderators are up here, right? Why haven't you had a 15-minute conversation with everyone up here giving their time to this podcast, to this room? I mean, set up a calendar invite. You know, I already have gotten an email from somebody this morning that's on this in this room. That is my call to action. Be part of this movement. Okay, we're here, we're small, we're mighty, but we're consistent and continuous with education, networking, and strategy. My quote this morning: make sure your worst enemy doesn't live between your own two ears. Please have a blessed Sunday morning. I'll be ending the room in the next 30 seconds. And thank you.